Oh god, I hate taxes. Of course, it's probably like trading stock, just because I don't know that much about it. Hey there, YouTube. Welcome to Big Mike Beard Wisdom. So today, we're going to talk about something that I always get stuck on after the beginning of a year. Something that I always dread. And it's not screwing up my resolutions, it's taxes. So 2020 was a pretty crazy year. And let's get into how I kind of handle my taxes this year. Because besides getting laid off, I took a little bit of money out as a COVID-related 401K withdrawal. And then also, I started the business doing YouTube videos. And at the end of the year, I took a job as an insurance agent. All right, so let's get into this. So every year, especially like around the beginning of the year in January, I always have to make myself a list of what I'm waiting for, what I'm looking for in the mail to be coming. And if you're a W-2 employee, you'll have W-2s coming. So you're an employee that works hourly or for a salary for a company, in which case they pay you based off of like time worked. Now, you could also be a 1099 employee, kind of like a salesperson or a contractor, in which case you get paid oftentimes without the tax being withheld. And you also get 1099s for different things. You get 1099s for interest incurred on bank accounts. And also for like E-Trade, I got a 1099 this year because I was able to buy and sell some. And then you also get a medical insurance verification form. I'm not sure what number that one is exactly. Having worked a lot of W-2 jobs, normally that comes from the employer. And then if you're married, you're also waiting for your spouse's W-2s, 1099s, medical insurance verification forms. So with starting the YouTube channel and also kicking around the idea of like doing merchandise or coming up with anything that I kind of invent that might be, good to sell, I basically started a business. And by having a home business, you're able to do some things tax-wise that you wouldn't ordinarily be able to do. So we'll blow through the business stuff just real quick. The way the last tax change went through, they removed a lot of home office deductions that you could take if you were a W-2 employee. But if you have your own business, you can still do some of those. So one of them is that you can take a home office deduction, and basically there's two methods to it. There's a simplified method and a more complicated one. But the simplified method basically is $5 a square foot that you use that's dedicated strictly for business use of your home, up to a maximum size of 300 feet. So the maximum deduction you can take under this is about $1,500. And this is basically what I just Googled real fast. Then you can see it came from IRS's website. And for me, the size of my office is less than 300 square feet. But there's certain things that we did over the course of the year that would allow more than the $1,500 deduction. So because we had actual work done to the office itself and had ordered furniture and other things, we're basically able to deduct that stuff as it's purely used for the business, purely for the office. The complicated part about the way that we did it, though, is that we had to go and measure the entire house and then divide the size of the house to the size of the office, and that allowed us to get a percentage where you could also claim the bills. So claiming the bills, we technically would have gotten more going with the simplified option as opposed to doing the more complicated deduction, but because we had all that extra stuff between the furniture and the work done, we were able to claim more this year. But going into the future, more than likely we'll wind up running the simplified version because I don't see us working on the office anytime soon, hopefully. But having a home-based business, you can also claim vehicle mileage. So there's some special rules for claiming vehicle mileage. And one of the big things is whether or not you're a home business or whether or not you work out of an office. So there's some rules as far as that goes. And I'd recommend looking into it before you wind up making any kind of claims, because there's a good chance that if there's a main office that you work out of, you driving to that office every day can't be claimed, even though maybe you drive out of that office to see customers later, in which case that distance could be claimed. And then there's also business expenses that we had this year. So with me taking the job as an insurance agent, there's license tests that you have to take, and we were able to claim the cost of those license tests. And then going into this year, for whenever I go to do taxes for 2021, I'll be able to claim certain things like the business cards. And there's also like miscellaneous items you can kind of claim on your taxes as well. So the state vehicle tabs or the license plate renewals, I think can be claimed, possibly maybe just on the federal side. But this is where I kind of get into like how I do my taxes. So for me, I don't do my taxes. So I've got a gentleman that I go to. He's a CPA, and I trust him a lot. So he's very good at what he does. There was a time where I was overseas working in Iraq and Afghanistan, and guys over there would take an R&R and do their taxes, come back and say, oh, look how much money I got back from taxes. And those guys went to some of the big box tax places, and it was a tremendous amount. But there was like a rule back then, I don't know if it's still in place now, but it's basically an expatriate tax exemption. So up to a certain amount of the money you made was tax exempt because you were working outside of the continental United States or outside the US period. And the gentleman that I did my taxes with knew about that, so I was able to get a much larger return. So it was really interesting when you go back and someone be like, oh yeah, I just did my taxes and I got this much back. And you're like, dude, you should have gotten twice that. So I highly recommend finding like a really good tax person, because they're going to find a way to maximize your return and get you the most money back. And normally they're going to be a little bit more expensive, but it's going to be worth it in the long run. So I live in Minnesota, and Minnesota does have a state income tax, and it works similar to federal tax in that it has a bracket system. And since I've been married, I've always filed married joint. But if you're curious about what your brackets are, it's really easy just to kind of Google a year, your state, and the tax brackets. Now, some of you might be lucky enough to be in a state where they don't have income tax. But for everybody else, I'd recommend you just take a look at it every now and then, just because sometimes the state tax will change, and maybe it's not on like the big like national news. But it's always interesting to see kind of how things increase or decrease. And then also, if you wind up searching for a year, I'd also recommend actually clicking on the links. That way, even though like this says 2020 Minnesota tax brackets, this might have taken me to sites that might have like the 2019 tax brackets for your 2020 filing. So sometimes the years can get mixed up. It's just one of those things you got to kind of pay attention. And here's a similar search to the federal tax brackets. And one of the big things that I always think is kind of funny is when people talk about either not taking a job or not doing something because they don't want to get into the next tax bracket. And I think some people think that whenever you get into a tax bracket, the entire amount that you were paid previously gets taxed at that new higher rate. But you actually wind up paying through the tax brackets. And looking at this one, you've got the tax rate, and then you've got different values for single individuals and different values for married individuals filing joint. And as you can see, the first tax bracket is 12%. So for anyone making up to $40,000 as an individual, or about $80,000 married together, you would pay 12% through that $40,000 and through that $80,000. So if you were a single individual making $50,000 a year, then basically you would pay 12% on the first $40,000 and 22% on the remaining $10,000. Similar to if you were married and combined you made $100,000, then on the first $80,000 you would pay the 12%. On the remaining $20,000 you would pay 22%. So I've got three examples kind of set up right here real quick. The first one would be if you were single and making about $50,000 a year. So here's your W-2 wages of $50,000, and then within the first tax bracket you would pay up to the ceiling of the first tax bracket, which is $40,125, and at 12%, that's $4,815. Then the remainder would go into the 22% bracket, so $98.75, and then that would be taxed at 22% for $2172.5. So your total tax that you would owe would be $69 $87.50, which your total tax percentage would be about 13.98%. So because you paid the full 12% through this one, and then because you only paid a little bit of the 22%, your actual total tax isn't that high. And then for the next example, what we're going to kind of show is that basically, if your spouse makes less than you do, or, well, you can even switch the roles, if you make less than your spouse does, it can kind of pull you into another tax bracket depending on how you file your taxes. So this would be the married filing joint. And what would wind up happening is that you'd wind up adding the two together. And then for married filing joint, the federal goes up to $80,000. So in this example, we're only at $75,000. So that would actually keep you in the 12% bracket. It would give you $9,000 that you would owe in taxes and give you a total tax percentage of just 12% because you were in the 12% bracket. So before we get into the next example, we almost need to touch on how the CARES Act kind of affects things as far as like if you took a loan or if you took a withdrawal out of your retirement plans. So I can't really speak towards the loan, but with me getting laid off, I essentially took a coronavirus related distribution of my 401k, put some into a retirement plan, but also saved some of it as a backup and just put it in my standard savings account. So if you wind up Googling this notice 2020-50, more than likely you'll come up with the IRS's website to download this PDF. And if you did take a loan or you take a distribution, I'd recommend you download this anyway. That way you can save it for your tax records. Now, if you did wind up taking a distribution, what happens is that money now counts as income. But normally, if you would have taken an early distribution from a retirement account, it would make you subject to a 10% additional tax. And a lot of times I always think of this as a penalty, not just an additional tax. So as far as I know going through this, it seemed like your employer had to agree to have this enabled, to say that they were in some way, shape, or form affected by coronavirus, I think, in order for you to have taken a withdrawal and selected that as an option. And again, I don't know anything about applying the loans for it, because I didn't take any loans. I directly wound up withdrawing. So the nice thing about doing the withdrawal was that you were exempt for a 10% additional tax, and then also you could pay back over the course of 3 years if you desired. Otherwise, you could handle everything in the year that you took the distribution. But this only went for 2020. Now that doesn't mean that they may wind up tweaking the tax code again and extending it, or maybe, doing something for 2021 as well. But in order of taking these out, you had to meet the definition of a qualified individual. I don't know if the headset's picking up the train. So basically, in order to have been a qualified individual, you would have had to have been diagnosed with COVID, or a spouse or dependent would have had to have been diagnosed with COVID, or you had to have been a person who experienced adverse financial consequences. You would have had to have issues financially due to being quarantined, being furloughed or laid off, or having your work hours reduced, or being unable to work due to lack of childcare, or closing or reducing hours of a business owned or operated by the individual. But there's a lot of good information in this, and I'd really recommend downloading it and reading it in case you haven't taken a withdrawal out. And the really weird part is that I don't remember if it's in this document or if it's in one of the other documents it references in here, but basically the 1099 that I received from the company running the 401k had it flagged as being an early withdrawal applicable to the 10% tax. So they could pick either one for the coronavirus related distributions, which kind of freaked me out when I first got that. So it might be the same thing for you. You might be like, oh no, here we go. But the big thing is that whenever you go to file your taxes, there's another form that you wind up filling out to show that you took the money and that this was based off of a corona related disaster withdrawal. So a cool thing with it is that you could either claim all the taxes in the year you took the distribution, so in 2020, or you can split those across the next 3 years. So you'd be claiming a third of it in 2020, a third of it in 2021, and a third of it in 2022. And then you also have the ability to make repayments either into your retirement plan if you still have the retirement plan, or if you were like me and you were laid off, into another qualified retirement plan. Now, everybody's situation is a little bit different, so you can choose to do it in a couple different ways, but we'll get into that last example to take a look at the way that I did it versus the way that someone else could have done it and saved that little bit of taxable income. So here we are back at the second example. And then this is pretty much how we're going to feed into the next one. It's just going to say that you took $9,000 out of the 401k. So instead of you just making the $50,000, you've now made $59,000. So you've now maxed out the 12% bracket, paying in $55,250 plus the $25,000, because that bracket maxed out married filing joint at $80,250. And essentially, with the additional $9,000, you now made $84,000 combined. So the remaining $3,750 goes into the 22% bracket. So anyone that winds up maxing all the way up through the first bracket will always have $96.30 due in taxes. And then for the last little bit, it's $825 in taxes, for a total of $10,455 in taxes. Now, that total tax is, of course, just a little bit above 12% because you only paid a little bit into that 22% bracket. And in situations like this, it's kind of handy having a spouse that doesn't make quite as much as you do and keeps you in that lower tax bracket. Just because that $9,000 distribution could have been much worse for this single guy. So it would have went basically from this 13.98, add the 9,000 in, and you're looking at 15% due to how much that grew here and how much further they expanded into the 22% bracket. But let's go back to this one. Given the two different ways that you can pay it off, you can either take the 9,000 in full the year that you took the distribution, or you could cut that down and do only 3,000 for 2020, then 3,000 for 2021, and then 3,000 for 2022. Now, if you were to cut this down to 3,000, then you would completely avoid this 22% tax bracket in this given situation, which would have saved you the taxable amount in this 22% tax bracket. But the big thing kind of depends on your situation. And for me, I like the idea of getting that full amount paid now. That way it's out of the way. So thanks to the business and the deductions, I was able to get a return of about $3,500 from federal and about $33 from the state. So had I split it into a 3-payment method, then I could have gotten closer to $5,000 from federal and closer to, I think, almost $1,000 from the state. But everyone's situation is going to be different. And the nice thing is that in that guidance form, it also explains out like which direction you take, be it you do a lump sum, pay it all off in 1 year, or you take the 3 payments. In some instances, you can file an amended tax return because also over the next 3 years, if you're able to put money into a qualified savings account for retirement, then that directly eats away at that money that you would have owed. All right, so that's pretty much it for the video. I'd appreciate it if you could subscribe. Otherwise, I'll check you guys later. Who was adversely financially... Train's just a going. All right, so I hope you guys learned something maybe. Oh, the fan would kick on. At least there's no train going by. It'll be a long video to edit.